Good morning and welcome to the first January 2026 Illinois Soybean Growers webinar series. And we're really excited today to have Gary Schnittke and Nick Paulson from the University of Illinois join us to talk about rethinking farm economics in this three-part series today, tomorrow, and Thursday. With that, Gary, I'm going to hand it over to you.
All right, thank you, Corey, and thanks for everyone being here today. We are going to do three webinars. This first one is reframing decisions around ag farmland and cash rents. So we're going to talk about that. And then tomorrow and the day after, reevaluating your on-farm investments, and then finally reassessing your farm income mix. So those are our three topics. And again, today we're talking about cash rents and renting farmland. Um, we're going to divide this up into five topics here. First, set the stage a little bit about farm returns and incomes, and then we're going to talk a little bit about where cash rents have been and likely where they're going, or provide observations on where they're going and the current economic environment and what we see. Then, then based on those observations, we'll discuss what some younger farmers may want to think about in those situations, and established farmers as well. So that's our outline. Nick is here with me as well, so we will do it, and Brian will offer wise and sage advice. So that's our outline, and I'm going to start us out on farm returns and income. So farm returns and income. This slide shows market year average prices published by USDA, WASD. They will again release a new one this coming Monday, so we will again see a new number there on Monday. Um, just a note of where we're at for the 2025 and 2026 year. USDA is projecting a $4 corn price for the entire year and $10.50 soybean price for this marketing year, which ends in August. And that obviously is considerably below where, particularly for corn, where we have been um, from last year and several years before. But in 2022, we saw 654 corn and 1420 soybeans. Here we are today. And when we look out at 2026 and where we see futures prices at and bids, we would be pegging that at 425 and 1060. So that is roughly the same as we currently have for this year, maybe a bit more optimistic, but nevertheless in the same ballpark. To put those prices in a little bit longer perspective, you can see those prices here. Um, in the longer run perspective goes, this slide goes back to 1990. Here's what I would say about this slide is that in 2006, we reached a new plateau for both corn and soybean prices. 446 has been the average since 2006, 1068 for soybeans. That new and what we typically see with commodity prices is that they don't trend up or down, but stay along a steady line. There's a lot of variability around that line, but nevertheless stay around that line. We've we saw that increase here because two items: the ethanol build happened and began in 2006, and also continuing strong export demand or growing export demand for soybeans. Those things have kept us at that plateau. And we simply don't see that plateau changing. You can have I mean, biofuels and offers some hope for more demand, but overall, you can't build the case that we're looking for something like 2006 to happen again, or at least that's my opinion. So we're here. And I would say for the foreseeable future, we are at $4 corn, 10.50 soybeans. So we're there. And here are our costs. This is Central Illinois. We're looking at Central Illinois cost here, and there's a couple of things to keep in mind here. Again, this would be for both average and book cost corn and soybeans, that those being grown in rotation. And we saw those non-land costs grow up and cash rents go up in 22, 23, along the same time that we saw those higher prices. And we've seen some moderation in those costs, but not much. And actually, I'm sort of of the opinion, I think Nick is too, that we're not going to see much more moderation in cost again, particularly for next year, and not for the year after that. Did what we did in 2012 and 2013. This was another period of high prices, cost rose, and then they declined a bit and then just hung in there. And we're at that same place. They rose, and now they're likely to hang in there. And that does present a problem because if we look at where prices are and where costs are, the break evens on this situation are above what the market is offering. Fortunately, or a fact, I don't know if you believe it or not, is that we are going to have significant farm program payments over the next year or so. And part of those is due to the One Big Beautiful Bill Act, which was passed last fall. That bill put in place a commodity title, and that commodity title is has higher payments. You will begin to see those higher payments with the 2025 marketing year, which you will get in October 2026. And the same thing for the 2026 marketing year. You will again have to make a decision um, about about which commodity title program you want, ARC and PLC, and we'll have some advice later on as we get closer there. But those two, well, will have significant payments, and we're estimating those in the 50-ish range. That bill also increased premium support on crop insurance. And one of the things that you're going to need to look at is purchasing SCO and ECO for the coming year. They increased the premium support up to 80%, and that will cause you to look at that. I'm not saying you're going to purchase it, but you're going to look at it. Then we will also have ad hoc disaster programs. ECAP is one that you received last year. This was paid on the 2024 crop. And the Farmer Bridge Assistance Program, which was just announced here, it will be paid on the 2025 crop, but it will be paid in 2026. Here is what those payment rates look like for corn, soybeans, and wheat. Corn, the FBPA will be $44.31 actually, $31 for soybeans and $39 for wheat. Those are again on the 2025 crop. You should expect to get those in March 2025. So, and again, those will be paid based on planted acres. So when we have the combination here of commodity title and ad hoc disaster assistance programs, we're for the 2024 crop, um, looked at $36. This is the ECAP payment and $5 for commodity titles. We're sort of in the 60-40 range here for 2025, and that's going to be pushing us close to $100 of program payments for the 2025 crop. Again, those will be received in 2026. And then 2026, we're thinking something in the range of ARC PLC being $45. And then I wouldn't be surprised if we see another ad hoc payment. But the combination of prices, lower prices, higher cost has pushed us into a very low return period. And this is returns on cash rent farmland in central Illinois. We could put the same slide up here for northern Illinois, southern Illinois. Cash rents are on an average basis. But since 2022, we've seen negative to low returns. Minus $47 in 2023, minus $43 in 2024. We're projecting 19 plus dollars in 2025. So that's better than the negatives, but it's still very low compared to where we have been. And when we do budgets for 2026, building in a projected our county payment of $42, we come up with a minus $17 return. So we're in this period of very low returns, and there's nothing on the horizon that looks like it's going to change that. And so this is the environment that we have to get used to operating in. And as a result of that, we are looking at lower farm incomes. We're looking at 2024 being in the um, near zero with a large amount of federal payments in there. We're looking at something bigger than that in 2025, again with a large amount of debt, federal payments, and 2026, sort of similar level. So we're in an environment where we're near $4 corn and $10 soybeans for the future, for the foreseeable future. We've had cost increases since 2022 and higher break evens. And the next set of higher prices will happen, but there's no reason to expect it. It could be 1 year in the future, 5 year, and 10 years. And finally, government payments are an important source of revenue, and it's likely the negative is that it's likely slowing down cost adjustments on cash rent and inputs as well. So that's the economic environment. And Nick is going to lead us through some discussions of what cash rents are looking like.
Yeah, so thanks, Gary. We're going to start by taking a look at the statewide averages that are reported by the National Ag Statistics Service of the USDA. And there tends to be, the danger in reporting averages is that often the average doesn't represent any individual in the room and their specific farm situation. But I think the averages are still quite useful, particularly when we're looking at trends in terms of where things are headed. You look at enough of these charts as Gary and I do, it doesn't matter. It seems like whether we're looking at prices, whether we're looking at returns, whether we're looking at costs, whether we're looking at specific components of those costs, like land costs here, we see this more rapid increase that occurred in the latter part of the 2000s, the early part of the 2010s, representing sort of the ethanol build and export market expansion period that we went through and the high profitability that brought. We see our costs, follow those profitability trends. That plateauing that Gary mentioned, a slight decline in plateauing in kind of the challenging period from 2014 to 2019. And then the big increases that we saw due to the high prices and high incomes and large government payments for that matter that we received in the 2021-2022 crop years. Um, Again, much like coming out of that high profitability period around 2012, 2013, we are starting to see some of these financial pressures um, uh, play out into some cash rent declines, at least in the average numbers that we look at, as well as some of the survey indicators that we'll look at in a second here as well. Nothing major, but about a $2 to $5 decline in these statewide averages from 2024 to 2025, which is exactly I think what we would expect to see. From the farmer's perspective, we'd like to see declines even larger than this, but in the averages, we're starting to see some of those headwinds in the cash rent market play out. Another one of the problems in looking at those averages is it does really mask a lot of variability, particularly in a state like Illinois, where the northern and central part of the state is so much different than the southern part of the state in terms of productivity. So we also track the county level averages year to year that USDA puts out, and this is the 2025 county averages that NASS published earlier last year. And the typical pattern here, we see some of the larger average cash rents in the northern two-thirds of the state, particularly right there in central Illinois. Lower average cash rents along the western and eastern edges, as well as the southern third of the state. Um, and again, kind of falling in line with what we saw in the small declines in those statewide average numbers in the previous slide, there are more counties with 2025 cash rent averages that were lower than those same averages in 2024 than counties with higher ones. But there are some counties where the average cash rent actually increased even from 2025 to 2024. Another thing that the variability across counties we should think of is there's a lot of variability across farms, even within counties. So if we look at that, some of those average cash rents at or above $300 in central Illinois, there's probably at least a plus or minus $50 per acre among some of the individual farm cash rents that you'd see that would capture a lot of the farms even within those counties. So a lot of variability across the state in these county averages, a lot of variability even within counties around some of these county average numbers. So those USDA numbers are important to track to sort of see directions that things are heading in. Another source that we look at is the cash rent information that's put out by the Illinois Society. Important thing to keep in mind here, you'll see in the middle of the table in the blue columns, those are some of the average USDA rents that are reported that we've kind of broken out by productivity class. And then comparing those to some of the columns in green in the right of the table, which is the average rents across productivity class for some of the professionally managed farmland across the state. Very typical pattern here to see those professionally managed average cash rents higher than what we see in the broader averages reported by USDA. Number of reasons for that. Professionally managed farms it is a much more competitive market. And it's also sort of an indicator maybe of kind of the leading edge of where rental rates are going, because these things are being renegotiated on a more regular basis in a more competitive environment. And you see the signals here are reductions, relatively small reductions from 2024 to 2025, bigger reductions in the excellent and good categories, and then larger reductions expected when the society members were surveyed last year in terms of expectations for rents in 2026 relative to last year, and reductions across all four productivity classes there. And what I would consider, and I think Gary would agree, pretty sizable reductions, in the $20 per acre range for a year-to-year change. That's pretty sizable in the cash rent market where we're looking at averages. Some of the other, excuse me, information from the society in some of the annual survey work that they do from last year. So again, survey participants expect those 2026 cash rents to go down by $15 to $20 per acre relative to 2025. And those were based on price expectations at the time, August last year, of just under $4 per bushel for corn, just under $10 per bushel for soybeans. Maybe a point I would make here is that one, it's not like we've got great price expectations now, but I think they are a bit more optimistic for even the 2025 crop than what was maybe collected here at the time of this survey. Plus the government payments that we're looking at between the changes in the One Big Beautiful Bill Act to the commodity tail and crop insurance, but also the ad hoc payments with the bridge assistance program that Gary mentioned. I think that could actually maybe temper down some of those cash rent reductions that were expected in this survey done last August if the survey was redone right now. Another thing that we look at, and there's a lot of information actually in this slide, so I'll try to kind of make the point here. One thing that we've tracked historically is the current return, the average current return to farmland in Illinois, which is just the ratio of the average cash rent to the average cropland price in the state, and how that has historically lined up with what we think is a pretty comparable, relatively safe investment. That's the 10-year constant maturity treasury rate. And those things historically have tracked each other pretty well. We did have the pretty big deviation between those two series leading into and kind of during the height of the 80s farm crisis. But in general, these things do tend to track each other pretty closely. Around 2023, we sort of came out of almost a 15-year period where the current return to cropland was actually favorable relative to what that 10-year constant maturity rate was. So there was that blue line is above the orange or the yellow line there. And then in the last few years, we've seen that current return to farmland continue to kind of trend down slightly to that 2.7% level for 2025 versus the increase in those in the 10-year treasury rate due to increased interest rate environment more generally. And that should also be kind of putting some pressures on farmland values. So, to get those two series back in line, if we look at how could that current return to cropland change, well, we could have cash rents increasing to increase that current return to make it more in line with alternative investments. That doesn't really seem to be like a realistic outcome right now, given the headwinds we're seeing, the financial stress on farms and what that's doing to cash rents. And so the other, way to look at that is we could be looking at some downward pressures on the denominator of that ratio, which would be farmland values declining, which again could bring those things back more in line. We're not necessarily predicting a significant decline in farmland values, but I think some of the other survey work that's been done out of Purdue, expectations from the Illinois Society and their survey do kind of suggest a plateauing, if not relatively small reductions or a softening in the market for farmlands here into 2026. Again, this is part of this is a chart that Gary showed you, but we added a couple series here that I think are important for historical perspective. And those would be kind of the comparison of the lines on this chart that we want to just spend a minute talking about. So the first one I'll talk about here is the kind of that light blue line, which is the average net farmer return. It's the average of those green and red bars here. And so again, this is based on a 50-50 corn soy rotation in central Illinois, cash rented farmland at the average cash rent for the region. And there's a lot of volatility here. There's some good years, there's some poor years, there's some really bad years, particularly 2023 and 2024 in terms of those returns. But on average, that net farmer return has been about $100 per acre. If we had the data to expand this chart back into the 90s and even into the 80s post-crisis, my guess is that $100 would be an average that would even extend back at least in the 90s, if not into the late 80s as well. And so, the message here is that despite the increase in the amount of dollars involved and the amount of dollars required to put a crop in the ground, we haven't really seen any statistical evidence of any increase in the net return coming back to the farmer in rented ground situations. Now, if we look at cash rent, and to be fair to landowners, we also put cash rent minus property taxes here, and you can see the gap between those two is getting larger as property taxes increase. But we do see that line is increasing. So if that's an indicator of the return back to farmland for farmland owners, we do see any growth in total returns to production increasing back to landowners, but remaining relatively flat to farmers, coupled with the very challenging situation we've been in since 2023 with the very low negative return numbers that you see there. All right, so overall, again, farmer returns on rented ground have not increased in terms of averages. We tend to have a lot of volatility in those things. Again, those green and red bars that we're looking at, we have a string of really good years, a string of really poor years. And we do tend to have longer periods when returns are below that average than strings of years where returns are above or significantly above that average. Returns are very low now. And as Gary said, when we look at sort of the global landscape, our best guess would be that, where commodity prices are at right now kind of represent global fundamentals. And it's really hard to think of a new plateau like occurred during the ethanol boom that is on the horizon here in the short term that could get us to new longer run price levels that would be consistent with profitability at the cost structures that we're currently dealing with. And a point that we'll talk a little bit more about here in the next few minutes is, historically, it's been a strategy, I think, for farmers who, want to expand to rent farmland and then use the resources generated on that rented ground to kind of build up the resources needed to maybe purchase some farmland and increase the owned land base or the overall size of the operation. I think that's a much more challenging and potentially infeasible strategy in our current environment relative to the success that strategy had historically. All right, so a couple observations, then I'm going to turn it back over to Gary to talk a little bit about kind of the young operator situation. So again, we mentioned this a few times. There are definitely pressures for reductions in some of the farmland rents that we're looking at, but those adjustments historically and I think again now will tend to be slow and slower than what we'd like to see. We have seen ad hoc programs step in here. Whether we think back to 2018, 2019 with MFP, some of the COVID programs, ECAP last year, FBA that was announced in December with payments coming in February or March this year. We'll continue to monitor that, but kind of the precedent has been set that's sort of built in as an expectation now. Another point, we won't spend a ton of time talking about this, maybe if there's some questions, but historically we have seen a growth in sort of a shift away from fixed cash rents towards variable cash rents. But in the current environment that we're in, sort of the traditional or common way to structure variable cash rents, which usually only focus on the revenue side in terms of determining a bonus or whatever the net cash rent level is paid for the year. Given the fact that we have our costs so high relative to our prices and then revenues resulting from those prices, even variable cash rents don't completely fix the problem in terms of avoiding some of those negative returns that we saw in some of the slides that we've already looked at. Another observation again is that there just simply aren't right now because of where our prices are at relative to where our cost of production are at. There just are not enough total returns, operator and land returns, to provide both a farmer and a landowner, if those are two separate parties, with what would be viewed as an average acceptable historical return level. So It's not that landowners are making out like gangbusters in this situation and farmers are bearing the entire brunt of this. Landowners have increasing costs too. It's just that we're not generating enough overall revenue relative to the costs that go into that production for there to be a sufficient return for both parties here. So with that, I'll let Gary talk about kind of the young farmer perspective.
All right. So we're all right. So the backdrop is that right now rental farmland is um, not providing. Well, it has provided negative returns for the past several years. And 2025, we're projecting a positive return, but that positive return is built on $100 of federal program payments, our PLC and the Farmer Bridge payment. And if we do that or look at that for 2026, we see the same thing. Um, and and this is a 50-50 corn soybean rotation budget for Central Illinois, showing crop revenue, ARC PLC, average cost and a cash rent of $327, and we come up with a minus $32 return. And again, this is for 2026. We haven't put a farmer bridge payment in there. You can speculate. My guess is that there's a pretty good chance that there will be one. There's no guarantee of that, but there's a pretty good chance of that. But even if that's in a $40 range, like it was this year, we've just pushed this minus 32 to $8. It's not even getting close to the $100 average that we saw from 2000 to 2022. And I'm going to just make the statement that for the foreseeable future, that's likely to be the case. Again, we don't see prices increasing and costs are coming down slowly, and it will take some more cost adjustments. And again, if you want to get this budget to $100, roughly $100 have to come off cost. Actually, a little bit more, but yeah, where's that going to come from? So we're probably looking at this for the foreseeable future. And when we do know younger farmers, we're going to have consolidation trends and they're going to continue, and there are still going to be needs to acquire additional farmland. But somewhat ironically, if a younger operator gets a new farm now, they could actually make their cash flow situation look worse with it than without it. So that raises a question. You're gonna likely have to need to generate cash from some other source to fund rented farmland, and that question is that a wise decision? In the past, we have used rented farmland, income from rented farmland to buy own farmland. And as we're looking at it, and again, his history isn't an indicator of future performance, but own farmland in the past has had comparable returns to the stock market, given a long enough holding period. We could see some declines in prices now. We could see some declines in prices not right now. We may not, but there's no reason really to believe that that has changed a lot. And so but the cash flow is really a problem because high prices. 80-acre farm in Midwest in Central Illinois is $1 million. And financing that is a problem. We also have this timing concern, and those returns may be low now, and that may in fact be the case. But for younger farmers, again, coming back, rented farmland could provide the basis for making land investments, and you just don't see that now. So If we want to make those land investments, and again, consolidation is going to happen, you likely need alternative strategies to fund growth. And those items could be develop other sources of income, and those could be other businesses on the farm in general. And we see farmers doing this already, having significant farm related and non-farm related businesses on that farming operation. And in general, if you have the business skills to run a farm, you probably have the business skills and entrepreneur ability to do something else as well. Um, so developing other sources of business, and then also having significant off-farm income. Um, and probably more important than the off-farm income is the benefits that go, the health benefits that go with that that uh, that operation. Again, so if you're a younger operator, we're going to have to focus on those other sources of income. Frankly, we've been doing that for a long time, but focusing on that is important. And then we're also going to suggest that if we want to acquire more rented land, we're going to have to make those rental farmland decisions selectively, and we'll have to do that until non-land cost or cash rents decline. And again, given where we're at on an average basis, we don't see positive returns. So we're making an investment, a cost investment in that land until something happens. So have to weigh the possibility of getting to the period where there's a positive return. And I would just say, right now, unless there's a lot of capital in that younger operation, expansion probably isn't feasible by a large amount of expansion isn't feasible by being a high cash rent bidder. If we're bidding above the average cash rents, then we have an issue, and we're just burning cash flow quicker. So, make younger operators are going to need to develop other sources of income and make those farmland rental decisions selectively. Now, there's also the other side of it, and the more experienced, established farmers. So, Nick.
Yeah, and we added the owned land column here to our crop budget table. And just to sort of set that up, what we typically, and it's not all about age, it's highly correlated with age, but when we look at data from really good sources like Illinois FBFM, we're projecting negative returns. We've experienced negative returns, but there's a lot of farm operations that are still, generating good incomes, positive incomes, still in strong financial positions. There's just as many above those average numbers, those negative average numbers that we're looking at as there are below it. And those tend to be the more established businesses that have some owned land as a base, which is particularly the last 3 years been in the position of subsidizing the rented land on those operations. And so we set this up just with sort of some example numbers here in terms of the costs associated with ownership. So we're at around $75 per acre in property taxes for good farmland here in central Illinois. We threw in a $50 per acre interest charge, assuming maybe that land is still being paid for, but we're on the definitely in the latter years of maybe a 20-year real estate mortgage that was used to purchase that. And you can see the sizable differences there in the farmer returns. And so again, a lot of the positive income operations that we're looking at are those more established farms, and it's because the owned land base, the gains on that are offsetting the losses on the cash rented ground. And so even these established farms, Gary talked about younger operators probably out of necessity and maybe not even really having a choice about making some of those rental decisions much more selectively. We kind of look at it from the established farmer perspective as also maybe needing to think about this selectively as well. So you know, a philosophy that I think we see among many farmers, and definitely my dad farms in southern Minnesota, and this is kind of resonates as sort of I think what his mentality has been over his 40 plus year farming career now is that we basically kind of hope for a break even in most years, but we're really waiting for the small number of years where we really hit those home runs and have some of those high returns. Examples, particularly in the Illinois numbers, would be the '07 and '08 crop years, 2010 to 2012, and then 2020 to 2022, with 2022 being the real standout year from an income perspective. Again, a decent share of that being driven by some federal support. The problem right now with this philosophy is when will those high income years happen again? And we're kind of reiterating this multiple times this afternoon, but we don't see another ethanol build necessarily on the horizon. Maybe some biofuel optimism, more marginal biofuel optimism from a policy perspective with some of the things we've seen with potential for more soy demand for biodiesel, or maybe SAF is something that we can set some hopes on to increase demand. But that's probably not next week. It's probably closer to that 10 years from now, unfortunately, that we might see those things play out. And again, we're in a multi-year cycle. 2026 would be what, a fourth year of basically negative returns if things play out like we currently project them to be. So again, even if you're in that established situation with a more stable land base, less cash rented acres, more owned ground that's close to being paid for or largely paid for, you kind of got to look at some of those cash rented parcels, I think, and ask yourself why you're doing this. And it's tough to let a farm go because you never know when the opportunity does arise in the future under more positive profitability circumstances. If you ever have the opportunity to get it back, that is a tough trigger to pull, so to speak. But again, given the size of some of these red numbers that we're looking at on a per acre basis, I think it's a question we need to seriously ask ourselves, even much more so than again that 2014 to 2019 period where we were kind of revolving around that break even level for a 5 year run. So to kind of wrap up and take us into questions here, again, the problem we're facing right now is low incomes, particularly on red land, because of low prices, not by historical standards or by what we think fundamentals suggest prices should be, but low prices relative to where our cost of production are at. Again, we're kind of in this cycle now. I would argue have been since MFP and the trade disputes that justified that in the 2018 crop year, where we've got these ad hoc payments in addition to our commodity title programs and our crop insurance program that are, at least partially filling some of these holes. But the problem we're facing is something that's much more structural and needs some longer term solutions for in terms of where our costs are at relative to where our prices and our revenue potential is at. Gary talked about the need for young farmers to think about alternative income sources. I think we'll talk a little bit more about that on Thursday, and still look at ways to, for feasible asset accumulation, particularly on farmland. And then even our established farmers who, have probably burned some equity, but are in still a pretty good financial position even since 2023. I think it's definitely time to start evaluating some of the individual rental situations that they might be in on specific parcels or tracts. So with that, Gary, I don't know if you have anything else to wrap up. Otherwise, we can turn it back over to Corey, and I think Corey wanted to talk about this slide for a second.
Yeah, guys, thank you so much. That a lot of information, a lot of content. I think we're looking forward to some good conversation here following up. So, quick reminders, a little housekeeping. If you want CEUs for today's talk, you can go ahead and hit the QR code on the screen now. And then if you have questions, I'm going to encourage you to either type them into the Q&A or raise your hand, and we're going to make your mic live if you want to ask a question live. With that, I also want to introduce Brian Sievers, who's our chairman, who's going to kind of add some to our conversation following the presentation. And with that, Schaefer, do you want to? I think your mic should be off. Do you want to ask your question?
Okay, Gary, too. Thanks, guys. Nick and Gary, you guys did a good job today. I know it's kind of a it's a shit sandwich, and I'm glad you guys are trying to put some mustard on it. So besides out yielding, the only thing that saved our ass last year was being able to out yield the cash flows, basically here and out in Woodford and McLean. Okay, my question is two things, Gary. On your cash flows for Central, what are you using for interest rates? Any idea?
So we would be having our interest rates, and we budget those interest rates based on what historically has happened, and then increase them. We've been increasing them, but we would be looking at operating notes in the 88% range,
Okay.
and
Okay.
so yeah.
Okay.
But
So
on that non-line cost, that would be the range we're looking at. We would see some lower interest rates because on land debt and some others, just because the item was done in the past.
understood. Well, and you did those, you were running them last fall too, before things started going down. Okay. So
Yeah.
I just was curious because that's one area, obviously, hopefully we can save some money, when we start redoing them here this spring. Next thing. Okay. So the $60 that's coming in October, is that technically, and I should know this being a crop insurance agent, I should know this. Was that for the 24 crop or is that actually for the 25 crop? Because this is where it gets muddy, and I guess what can we look for? You answer the question first, then I'll ask the second question.
No, this is always the confusing part. So the payment that you will get in October 26th is related to production in 2025.
It is.
So
Okay.
So if you took our county, it will be the yields that were done in 2025 and the market year average price for the 25 marketing year. So yeah, the timing of this is really so when you look at a farm and you look at the cash flows for one crop can span 3 years. So
Exactly.
sort of unmessing that up is an issue.
And then I
would add too, Gary, that those payments are still projections.
Yeah.
So that $60 could easily turn into $40. Could turn into $40 easier than $80 because at some point we sort of hit the max payment, particularly on ARC. Although for 25 you get the bigger of the two. So, but if our market, if we went on a rally, in the next 3-4 months and that marking your average price came up from where we think it's going to be, those payments could be smaller. And depending on what your marketing plan was for your 2025 bushels, maybe that's fine if you get to take advantage of that price increase. But those are just where we think they're going to be. They're not a guarantee.
And the MYA goes through September 30th?
August 31st.
August.
Okay. All right.
Yeah.
So then the next thing, and I'll get off there, I swear, Brian, don't get mad at me. So in the farm bill that got paid, they did all the farm bill stuff at OBB, and which actually helps us because they didn't lower the average prices. We will still have those for 26 then because we didn't reset the reference prices. So that'll help us on ARC and PLC for 26, possibly if the yields are rough.
So it definitely is. So the ARC benchmark prices and the effective reference prices will be higher.
Yep.
In 2025, they're probably going to start coming down in 2026, but not a lot. It's going to take a couple years. Or go ahead, Nick.
Well, I think So what'll happen for 26, and we know this, we shouldn't say what will happen. I don't have the numbers on top of my head, but we're for the 2026, which payments would not occur if triggered until October of 27.
Correct. Yep.
For the 26 crop year, we're actually going to see higher reference and ARC benchmark prices than 2025. And those are set regardless of what happens with the 2025 price, because we're rolling off the 2019, 2020 marketing year, adding the
Yep, yeah.
24, 25 marketing year, which is set. So they're going to be a little bit higher actually. But like,
Really? Okay.
but as Gary said, in 27, I think we're going to expect to start to see those ratcheting down. So that effective reference price is going to start to come down because we're going to start to roll in some of these lower prices we've had in more recent years.
All right. Well, thank you for what you guys do. There's a lot of information. I know, like I said, things aren't real pretty, but hopefully we can out yield our balance, our cash flows this year. Thank you.
All right. Thanks, Schaefer, for joining or for asking live. And again, anyone that wants to ask a live question, feel free to raise your hand. I think I just want to transition real fast. I think Schaefer made a really good point. And Brian, I'd love your perspective on this. What type of mustard do you prefer with your shit sandwich, Brian?
Does that mean luck? Does luck count? But
Oh my gosh, sorry. I had to poke that. So we have a lot of questions pre-submitted, and we have several getting submitted through the Q&A. So feel free to put those in. Brian, I do want to kind of transition to you, kind of that farmer perspective. I have the privilege of knowing you a little bit and knowing your operation. I know that you're transitioning to your sons, and I'm just kind of wondering what kind of advice in the current climate, when we're talking about taking on new ground, rental ground, what kind of advice would you be giving your sons right now?
yeah, that's the hard part. I appreciate Gary and Nick's insight on all this. It's a shame they're hauling grain, so they couldn't listen, but hopefully they can watch the recording of it. But what we're trying to do is I brought them in as employees a long time ago, and we try to grow the business. And we've been able to have some 50-50 stuff, but then a lot of the growth has to come from cash rent. Now, I don't know where Gary and Nick get their numbers, but ours aren't that low. I wish they were, to be real honest with you. They're not. It's very competitive here in Vermilion County. And to try to help the boys who they both talked about young farmers. It's really tough to be a young farmer and say, okay, well, all right, now I got to go buy a combine. Now I got to go buy a tractor. Now I got to go pay cash rent. Now, oh shoot, now all of a sudden, inputs have went up tremendously. How am I going to do it? They have to do it. They have to have some help somehow, whether that's from their father, from somebody they've worked with forever. That's why working together with your father, like I'm doing for the boys, is we're going to set up an LLC. An LLC will bring them in slowly. They don't have to buy my equipment, which is my retirement too. I don't want to give it away, but I'll give away as much as I can. But this high cash rent thing is really tough to grow the business because I try to emphasize to them buying farm ground when they're young, but that's really tough. Their wife has decent jobs, and that helps with the supplemental income. But we need to come up with, listening to Gary and Nick, something for this farm to do. We do custom app for people because we own our own application equipment. So that's kind of been part of it. We do fungicide and spraying for other people. But there's still, for three families, this farm is trying to support three families. And cash rent is the only fast way to add acres. And it's very competitive and very high price. And for young people, I've built up a little bit of a war chest and doing this since 1988. They have not had the opportunity to do that. So I can survive these down years like we're having right now. But I got to go back to that war chest and borrow some money from, and then when we have the good years, like they showed on the graphs, you got to put some more money back in the war chest, not necessarily go buy you something. And that's what makes it hard. I mean, I would entertain Gary and Nick to kind of add on to that, but that's kind of the plan we do at Seavers Farms. I don't know a better way to do it, Gary. or Nick.
No, no, you're you're exactly right. That building that up and saving it during those good times is an important thing. We're not there right now, so if you didn't build it up, then we're here where we're here. So, um, yeah, I mean, you've there's not a way to make what what you said is different than that. And again, we're particularly on Thursday, we'll talk about, you do have to develop some other income sources for that operation. And that isn't going to look that's going to have to look different for each operation, because if everybody did custom work, that we could drive that just like cash rents. We could
Mhm.
make that unprofitable as well. So yeah.
Yeah.
And I appreciate that. That was good. So we are getting some questions. I'm going to keep this rolling as long as we can here, but I'm going to ask. Hey, let's try to answer questions quickly because we got a lot, and we might have to answer some of them the next 2 days. But just live. Um, Here, I'll just answer this question was submitted. Where does the marketing of crop fall into the farmer's returns? Any thoughts on that, Gary, Nick?
So, I'm a, you know, the, I think, and maybe I'm misunderstanding the question. I think the marketing of the crop would be the crop revenue that you get from the crop, and if we manage to hit some higher prices, we would see some higher crop revenue there as well. So that's one place where that would show up. So Nick, you got.
Gary, if I could chime in there for a second, what we try to do is look for specialty things. So
Yep.
like my dad, when he farmed, he just took it to the local elevator and they need to figure it. So what we've taken on is non-GMO beans. And
Yep.
so we know our market, and so you get a little added bonus. Now you got to deal with
Yep.
some weeds, you got to do some other things, clean out and etc. But to me, that's a way to help a higher cash rent ground is make it more profitable by doing that, by doing the center fields at places, food grade corn, get an extra 20 cents,
Yep.
whatever. That helps pay for the extra cash rent. I think that
Yep. Yep.
quick
Nope.
was Corey. I don't know.
Yeah, and I think that's something Gary and I have both talked about in other presentations the last couple of years, particularly is kind of commodity plus, like, not completely changing some different crazy cropping system, but relying on what you've got experience in and what you're good at, but finding those kind of differentiation opportunities even within the commodity space. And sort of the way I maybe looked at that question was, maybe I'm looking because I have an answer to this, is that, when we look at farms that do well relative to peers historically, marketing strategies is not where we see the differentiation between the farms that do well and the farms that don't do so well. And I mean that in relative terms. So, everybody did good in 2022, but some did better. And it's those farms that do better. It's the ones that in the data we look at for Illinois farms, it's the farms that have their costs side under control. And they're just the gap between the in financial performance through time is more built on that cost side and the financials of the business rather than, hitting those marketing home runs, which are really tough to do consistently.
Nick, I love that comment just because I had a conversation earlier today with a farmer, and their big kind of conversation was very much the guys that can do math are more likely to be okay than the guys that aren't doing their math. And he meant, knowing their budget, knowing their costs. So I want to keep the questions going. Uh, we had a question. What has been the sentiment amongst landowners for decreasing cash rent prices to share the pain? Has there been any sympathy, or are they standing firm? So I would love, maybe Brian, if you've had any conversations, comment there, and then Nick and Gary, Just some thoughts, because we did get 4 or 5 pre-submitted questions that were along the line. How do we talk to our landowners and let them know the situation we're in?
Yeah, I guess an example that just happened recently. My cash rent stayed the same, or one went up, none went down. With the conversations with them from this fall, one of them especially told me and pointed to me as he spoke, "You're getting money from the government, so I'm not lowering your cash rent." There you go. So yeah, if Gary and Nick got any great suggestions for a farmer having to negotiate cash rent with the landowner and or a farm manager, that would be great, because it's really, really hard once they got to this plateau, raised it over the last 4 or 5 years. They are not willing to come back down, because that is the money that they're using. So, Gary.
No, no, I, well, both Nick and I have talked to landowner groups, and um, I, most of the landowners that I most of the landowners understand that the economics aren't all that good right now. Um, I would say that they aren't all that interested in seeing the rents come down either. So, um, and they do point to the payments that are happening, and yeah. So I guess the best thing that would suggest doing to farmers is, or for landowners, is just maybe you do this with some Farm Doc Daily articles or your own returns, and just show them what's happening out there, and that way, just so everybody's being transparent with what is the cost and the returns, and it isn't good, and we do have an issue here, um, and something has to change, and it will change when it has to change. But yeah, yeah. So I guess I would make that preparation um, ongoing.
Yeah, and
I
I think Brian's right. The downside of these government programs, the big downside is exactly what his experience was with that landowner. Is they see the news just like everybody else, and I not to promote Farm Doc Daily information too much, but Gary's right. I mean, I think we are very honest in the numbers we put out, and those returns include those government payments that have occurred through time. So be honest, communicate. I think younger farmers, especially, I think a lot goes for maybe going that extra mile. You got an older landowner, do what you can to help them out throughout the year with, just make it a little bit more of a business relationship, so that sympathy can actually get factored into some of these economic decisions.
I'd like to show them your slide deck that you just presented to us. That would be useful too. I think.
Well, and the slide deck should be shareable here after these webinars, so that's a great ad. Just keeping the conversation going. One of the pre-submitted questions, we got basically multiple forms of the same question, which was, what makes cash rents go up? And maybe more importantly, what makes them go down? So just real quick, Gary, Nick, what are some bullet point thoughts? How can guys think about what's going to make it go up? What's going to make it go down?
So we are seeing some decline in the averages. So and those aren't those aren't large declines. Um, and if you look at the history, there are some declines. We saw some declines in 2015, 2016, and 2017, and we're seeing some decline in 2024 and 25. We're projecting. Most of that happens, in my opinion. We can't delve into this in the averages, but it's really high ones coming down uh, somewhat. To have an appreciable decline in land rents is something that we haven't seen since the 1980s, and no one wants to go there. So yeah, we
Gary,
haven't seen it.
since you
Nick,
brought up the 1980s, I'm going to ask you this question. I know we're not in the 1980s, but is this the closest we've been since the 80s from a farm economy standpoint?
so this is the lowest returns I have seen in my career as an ag economist, and it's since since at least the 1990s. Yeah, I would say so. But what they're the lowest returns. What made the 1980s so bad was that the interest rates went up. We had so much debt out there, and those interest rates went up, and then the farmland prices fell, and we've got farmers into insolvency position. I don't expect that, but what I would expect is some of the less the farms that have the less working capital in their balance sheets are eventually going to be forced into not doing something by the lending decisions. And again, that's a long, slow, grinding way of doing this sort of thing. But this, from just a returns, particularly to cash rent farmland, is just the worst since the 1990s. These last several years.
Well, you made the conversation kind of depressing now, Gary. Um, I think kind of building on that thought, we did get a couple questions about interest rates, and I think you kind of suggested this. Obviously, we're not anywhere near kind of worst case scenario, but maybe it feels like it's trending up. Where do you think the stop is there? Is it trending up, and do you feel like there's a stop, or what's the realistic scenario going into 26 when I think about interest rates?
So Nick, have you been following this?
Yeah, I mean, I think if anything, I think there's maybe even better odds we'd see a slight reduction in interest rates heading into 28, just from a monetary policy perspective. Um, and I just think it's, I've talked about this with students who we have in classrooms on campus who their entire lives have been declining interest rate environments. And so they talk about, 6, 7, 8% as being outrageous. And then I show them a slide that goes back into the 80s and the 70s, and it provides a little context. So, um, I don't think we're headed back to zero Fed funds and, uh, under 3% 30-year home mortgage interest rate territory, but um, I'd put higher odds on there being slightly lower interest rates for the 27, 28 crop years than what we had for the 25 crop year, but not half as high as they are now or anything like that.
So one of the other questions we had submitted, and this is a little bit, I think we've kind of talked around it, but just really direct. Today's market, what red flags tell you that a cash rent is I guess, an opportunity or maybe something you should walk away from? So what are the key decision makers farmers can walk away and say, okay, this is even though it looks like an opportunity, we don't need to go there, or this is a real opportunity.
Yeah. So here, I would first off, um, uh, so we're likely looking at a high cash rent, and if you're taking above cash rent, or cash rent that's cash above the average, you got to question it, and then you got to if you do take that, you have to make a judgment, um, all right, I'm going to hold this land for 5, 6 years, and hopefully we hit on 21 and 22. You have to look at that landowner and say, are they going to stick with me in 21 and 2022? And that is a imprecise judgment to make. I would get really skeptical about going into a high cash rent situation with a variable cash rent with a very high base rent, and then a kicker above that, because you're taking away the possibility of those high income users. So, you know, anything that looks high, and this individual is going to then make a decision when higher incomes come about that we're going to get more, is the situation that you definitely need to walk away from. So, and even the averages, you got to make a decision. You can't. You got to make a. You got to be able to farm that and have the financial wherewithal to do it 4 or 5 years, um, because there's no guarantee that in 4 or 5 years there will be a higher price scenario. So,
Well, Gary
Nick,
brought up a real, oh, sorry, Gary, I'm sorry.
go ahead, Brian.
Yeah,
No,
Gary brought up a great point. The variable cash rents scare me because, I mean, if unless you can start with a $200 base, those variable cash rents, if you start out with a $300 base, the variable cash rent take away your chance to have made some money if prices are high and you produce a good crop, which you want to produce a good crop. Those always scare me. Another thing that we try to do is get a soil test, because you never know what, you got an idea who farmed it before you and what they might have done. But if you're starting out with soils that are very low in P and K, and you need to dump a bunch of lime on it to get it back up there, that's another thing that's a key red flag to us. So,
So I know we're kind of approaching our limits here, but we did kind of building on what we're talking about right now. We did get a pre-submitted question. What do you recommend that's on this same train of thought here? What do you recommend using for the pricing mechanism in a flex rent lease? So what's the right way to think about this flex rent lease? And Gary, Nick, maybe you can add to that. And then Brian, your thoughts on leases and what's the right lease? I'd appreciate.
So if you're going to do a variable cash rent, the first thing is to get the base lower, and it should be a bit lower than the average cash rent. The pricing mechanism, I sort of we sort of look at an average price over a specified period, 4 to 5 months, with harvest in there, and those are average price during that period. The one thing that I would say right now is those typically we see rent factors, and the historic rent factors, Nick, are what, 30% or something like that?
Yeah, 30%, even a little higher in central and northern Illinois.
Yeah, they don't work now with these high costs. So, uh, lowering those rent factors is the other thing that if you're going to go there. We publish rent factors that over the last from 2000 to 2023 would have caused the cash rent and the variable cash rent to have the same return. Well, we're not in that. That they don't help much now. So lowering that rent factor is one of the things that you have to think about doing.
Well, and if getting the base lower, or the landowner is wanting to get the base higher, if that's sort of a sticking point, I mean, I think for the last couple of years we've sort of started recommending not only a base which provides the landowner with a minimum, but that if your base is too high, you got to make sure you've got a cap to where that thing can't get out of control on the high side from the farmer's perspective either, because otherwise, like Brian
Yep.
said, you're just taking away all your high end potential and giving that to the landowner, and they're completely protected on the low side. And then I don't know if the pricing question was also a little bit about, what information you use to set the price that determines. I mean, I think now in this environment, more so than any, that's probably going to affect your marketing, or you got to set that to be consistent with how you market, because the potential to get sideways here in how you sell your grain versus how that price is determined on a flex, just the number of dollars we're talking about is too much to mess with. So, yeah, you could hit a home run, but one or two really bad outcomes on some rented ground, you could come close to losing the farm too.
You hit a home run, or you could strike out real easily.
Mm-hmm. Yep. Yep. No, and that I agree with both of them. You got another question, Corey? Go ahead, because I don't have. Yeah, go ahead.
No, I think that all I want to just kind of wrap up here with is maybe some thoughts on what's the one thing a farmer listening here could take away from today in terms of how, what's the one thing they can do on their farm to help go into 2026. And maybe Gary, Nick, some thoughts, and then we'll end with you, Brian.
So I'll list two. I would talk to all my landowners and let them know the financial situation as it is. And number two, number two is I would be looking at every cost outlay and making sure that we're maximizing our return and not our yield. And those two things are something that we can do from now till till planning, and then we can talk about some of the longer run investment decisions we'll be making.
Yeah, I would just reiterate kind of that point. I think that's one Gary's been making a lot in the last couple of years, is maximizing profit or return, not yield. I think the yield maximizing mentality is something farmers tend to be in, because that's sort of something viewed maybe more in control, but the financial side is somewhat in your control too. And even if you have to give up a few bushels with a lower application rate on some nitrogen, that's a much different outcome on the return side when corn is $4 than when it was $6. So yeah, it made sense to maybe apply above recommendation rates from the university when corn was over 6, but it's just a lot different when corn is 4, or
Yeah,
beans are 10 versus 15.
sure, sure. And those are great points that I try to express to the boys too, which are young farmers, is chasing 250, 300 bushel corn takes a lot of money to get there, no matter what you do. And sometimes if you look at your cash flow, you can maximize at 220, you make more money than you did at chasing the 300 bushel. So those two are great points from Gary and Nick both too. But I guess I'd also like to say, um, all the farmers here, being a member of the Illinois Soybean Association gives you the opportunity, or the Illinois Soybean Growers, I'm sorry, gives the opportunity to listen to Nick and Gary and get some great insight from all them. And so that's part of helping you be a better, or be a be a profitable farmer. I wouldn't say better, be a profitable farmer, because that's important. So I appreciate all of our staff and our two guests today, and hopefully everybody can attend the next two days. So I appreciate all your time, and Gary and Nick for your time, and Corey for putting it all together, and hope to see everybody tomorrow.
All right. Thanks, everyone. And again, just a reminder, there are two more webinars at this same time tomorrow and Thursday. I encourage you to use the link to join those tomorrow and Thursday, and also consider that ISG membership. Thank you so much.